What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome to Raise the Bar Radio, elevated conversations around entrepreneurship, capital raising, and real estate. Today we have Gino Barbero, a legendary investor, entrepreneur, and author of 3 best-selling books. He's the co-founder of Jake and Gino, a multifamily real estate education company founded on the framework of buy right, manage right, and finance right. Gino, old friend of mine, welcome back to the show. Good to have you on today, buddy.
Seth, I appreciate being on because I think we're going to get a little of our frustrations out on this episode and have fun while we're doing it, right?
Let's do it, man. I don't want you to hold anything back, brother. I want you to just say what you need to say, get it off your chest, and let's have some fun with it.
Well, after spending 10 minutes feeling like an idiot and not even being able to get on the show, that was the precipice. I said, you know what? I'm going to let it rip on this show. And I'm going to start off by saying that I don't know jack shit about what's going on in this economy right now. And I've been investing for over 20 years. We own 1,800 units. I don't have any syndications. It's my capital. We're printing $300 in profit per unit. So I have the track record. I have the experience. And yet I don't know what the hell is going on. And why is that? There's a reason why. And I don't think we could really have trust in the institutions and the data that we're getting. And this is not one side. It's not politics. It's policy. First, inflation was transitory. Then we got whacked with it, right? Then there's 17 million jobs. Now, did he create any jobs? Tariffs were supposed to create this inflation. Now it doesn't. Now, I don't even know what to believe, what not to believe. And I have to be honest, Seth. Am I the only one feeling this, or are there other people out there? That's the frustration that I have. But I can always lean on our framework of buy right, manage right, finance right. The fundamentals of real estate haven't changed. Maybe the strategies have. Well, maybe harder to syndicate deals right now, so you might have to JV or get a small group together. You can, go out there and sell or finance a deal or master lease option a deal where you couldn't a few years ago. But right now, and the reason why I feel this way, and I think the vast majority of really good investors feel this way as well, is there's not a lot of deals being traded because sellers are still in la-la land and buyers are like, I've already gotten burned, and if I go to the bank, they're going to laugh at me. So it's just like this weird spot where we're at. And I'm like, how do you do a deal? I mean, we did 300 units in 23. We did almost 200 units last year. We've done a 68-unit deal this year. Now, it was phenomenal, but I mean, that was it. And it was actually from a seller who sold us 2 previous deals. Anything that's going online, on market right now, is just not worth bidding. There's older assets. There's a lot of work to be done. And it's stuff where, they're 20 to 25% from where they were 2 years ago. They need another 20, 25% haircut. So I know usually people jump on and say, I've been in business for 30 years and all. And I want to skip to that and get to the meat of the conversation because I want to know how you feel. How do you feel about what's going on with the market and the economy right now?
Dude, I agree. It is crazy times because everything is politicized, right? So you can't even take what are presented as facts as facts. And
yes.
Then when that happens time and time again, even when it's presented as facts, and it's proven later and you're like, oh, just kidding. There were actually a massive job loss. It wasn't a positive. It's like, well, you just made all the interest rate cuts or not interest rate cuts based on these things over the past year. And now you're telling me that you just didn't report it right. It's just like, what the hell are you supposed to do? Because it's hard to live life that way also. It's hard to have to literally question every single thing because where's the truth, right? You get into the data and the data's wrong. So where do you find that source of truth? There really isn't one. So it's really difficult to make decisions.
But the positive thing for us is we're in a good market. We're in our East Tennessee in Knoxville. Just understand, I think to be clear, is if you can get clarity about what your goals are. If you're just starting out, you're going to have a different, underwriting template. You're going to have a different strategy than if somebody who's been in the business for 20 years. Are you going to be doing this part-time, maybe investing passively? Or do you want to get into the GP side? Or do you just want to start buying 10-unit deals, small deals by yourself? There's so many different things. So before you start getting into the market and saying, I got to get a deal, don't do what I did. Don't just jump in and try to find a deal. Try to really follow somebody's strategy, somebody's framework that they've put together, and something that resonates with you. And I always say, Seth, I had a life before Jake, and I had a life after Jake. Before Jake, I made every mistake conceivable. And that sucker, because I call him a sucker in a good way, he hasn't lost money on one deal because I was the one who lost all the money before I met him. Then I got in school, I had mentorship programs. I was fortunate enough and blessed enough that he arrived into my life when I had the experience and the knowledge, and we just partnered up. And I say jokingly, he's an incredible partner. He has really done an amazing job over these last 15 years. But it's interesting when you're running around with a chicken without a head, without a process, without somebody having the experience. And that's why it's important. If you're just starting out, maybe by tipping your toe in the water, you go as a passive investor and you find out what people are doing. Log into every person who's doing a syndication. Try to get their offering memorandums. See everyone's different strategy, because there's no one size fits all. There could be a syndicator raising money for self-storage, ATM machines, mobile home parks, multifamily. What is it that you like? I love multifamily because I like the customer service aspect of it. I like the fact that it's a basic human need. I like the fact that more people are renting. That's the reality. Less people are buying homes. Renting is becoming more convenient. So I think long term, it has that as well. So just go out there, try to understand what you're trying to accomplish. And then once that, just pick a vehicle and learn about the vehicle. Give yourself some time to actually learn about the vehicle and grow with your experience.
Yeah, 100%, dude. There's different levels to it, right? You've got to, when you're first starting out, you've got to get yourself in the right rooms. You've got to network. You've got to get yourself exposed to a bunch of different things, because you don't even know what you want. Like maybe you listen to a podcast or watch a YouTube video and you're like, oh, that sounds cool, but you don't really know what's out there yet. You need to figure out what's out there first. So get kind of a general idea of like, it's not just multifamily. Okay, there's mobile home parks, there's RV parks, there's debt funds nowadays, there's oil and gas, all kinds of stuff, right? Like get yourself exposed to what's out there first, and then start formulating which one you want to go with and what's your end goal, right? Because I think a lot of people, they see like, see a lot of like coaching programs and things like that. I run one, you run one, but it's just like, well, what are your end goals, right? Like, do you want a lifestyle business or do you want to own $1 billion in real estate? Not everybody needs to own $1 billion in real estate, right? Like you hear that number all the time, or even $100 million, like all these crazy numbers, but that's not for everybody. Like you're going to have to bring in investor capital to do those sorts of things. Like you're going to have to make sacrifices to do those sorts of things. But you know what? You could probably JV or just buy a few smaller multifamily assets or a little retail shopping center around the corner and make some nice cash flow and quit your W-2 and just live off of that. Like you don't have to go all the way, right? Like think about like what your goals are and what's going to make you and your family happy.
I want to learn a little bit about you, and then I'll share my story of how what you just said really highlights the transition that I've had over the last 15 years with our portfolio. But when you started, what were your goals? Were your goals, hey, I just want to do this a little passively, figure out the real estate thing, make a little extra income, then grow the business, and like, oh, wow, I'm doing this fund the funds now. What did that look like for you?
Yeah, for me, it was going, I am an all-in type of guy. So I was like all in. I was like, all right, how can I buy as much as I possibly can? But I also am a lawyer, so I had to kind of tippy-toe first. So I invested passively. I bought a duplex, house hacked into it, bought bigger 4-unit, a 10-unit, a 16-unit. Then I started raising capital with operators, and then I started being the operator. So I kind of like stepped my way up with the end goal that I wanted to go big. And now I've actually kind of come back because I'm like, you know what, like I don't want to just own a few percentage points of all these deals. Like I'd rather just own, a 30 unit where I own 100% of it, or I own 25% of it with a couple of JV partners, or try to find some trophy assets, right? Things like an awesome short-term rental in A+ market that's only going to appreciate over time, and I can use it with my friends and family and go visit and utilize the property. Things like that, more like kind of lifestyle type of decisions. So I think it evolves over time.
And what was the switch? What was the epiphany of the moment in your life that you said, I don't really need to go all big. I'd rather do a 30 unit that I own all the equity instead of having 17,000 units and having 1/10 of 1%.
I think it came down to operating. So the bigger assets that I was actually operating on, doing the asset management, I was like, all right, here we go. This is a lot of work. Not saying I didn't know it was a lot of work. I'm a business owner and other things too. I know it's going to be a lot of work, but I'm going to have to build out a team, a big team. It's going to have to grow. It's going to have to be a massive business if I want to own $100 million, $500 million in real estate, right? Mm-hmm. And it wasn't necessarily something I wanted to do there. I wanted to keep things on the simple side. And that's when I started saying, I'm not going to be able to do this by myself. A lot of work. This is not necessarily what I want to do. I got into real estate for freedom, for flexibility, for cash flow, and this is probably not going to create that for me.
That's a great answer. So I'm just writing down and as you're listening to this, ask yourself this question. Yeah. What are you getting into it for? And that's important because you may want to get into it to make $1 billion. And that's why what I've done over the last year to 18 months, I've transitioned from just teaching people about real estate to becoming a certified money coach. Because it really comes down to your relationship with money. Sure. I mean, we all view money differently. Money is not the problem. Money is usually the symptom. So if you want to hit $1 billion, man, I want you to crush it. But really ask yourself, what's the real reason that you want to hit $1 billion? And right. I always ask yourself, when is enough enough? Because people always say, when I make more money, my problem is going to go away. And I realized I had 100 units, had problems. Had 200 units, had problems. Have 350 million assets, there's always problems. Making more money is not going to solve all of your problems. And actually, I've got a spousal lifetime access trust now. I've got 6 kids where I've got to create estate planning. So I'm not complaining, but I'm just telling you, it creates different kinds of problems. So your story is very similar to ours. When we started, Jake and I were like, bro, if we can hit 100 units, we're going to be like 2 pigs in crap. And it took us 18 months to find our first 25 unit deal. But 3 months after that, we closed on a 36. So we're at 60 units within almost 2 years, which may not seem like a lot, but it is a lot when you look back, because what happens is you have that hockey puck curve. Because then I remember in February of 2014, a year after we closed that first deal, we closed 136 units. So within 3 years of Jake and myself meeting and starting, we had 202 really excellent units. There were 3 deals. And within 5 years, we had a little over 500 units. And there was no syndication involved. It was refi and roll. It was a partner who had a significant balance sheet who helped us out. And interspersed in that, we closed on a 200-unit seller finance deal. So people are like, well, how did you do it? A little seller financing, a little JVs, refi and rolls. But then at 500 units, we're like, holy crap, we're sort of got lint in our pockets. Where are we going to find money? And oh, by the way, everyone's talking about this syndication thing. Yeah. Let's try it. And Seth, we did 3 deals in syndication, 2 in 2018, 1 in 2019. We saw that it wasn't for us long term because we wanted to hold a really quality asset for the long term. And syndications, in a lot of instances, you put money in, and then all of a sudden you have to return that capital. And sometimes, if you're lucky, you can actually refi it out. But as the GPs, we're doing all the work and we're not getting compensated as much. So we said to ourselves, after the third one, let's stop, regroup. We've got more capital. We sold those off, and we continued to buy our own. And one of the things I want people to focus on is, when you're in business, what is the KPI that you're really measuring? For us, it's PPU now. It's profit per unit. It's not number of doors. It's not IRR and cash flow. That's what we want. At the end of the month, we have 1,800 units. how much profitability does those 1,800 units are giving us? That's what we're looking for. So from a syndication model, it doesn't really work. From a syndication model, you're trying to expand, you're trying to get as many units under management, you've got asset management fees. It's a different model. We didn't like that model as much. We did what you did. We put the e-brake on, and we're going to do smaller deals with our own capital, and we're going to really control those deals. And we're vertically integrated. We have our own property management company. So that's not for everybody. And I hate when people say this is the only way to do it, only buying multifamily. If you want to really get rich in the next 10 years, if you buy one single family home for the next 10 years, within 15 years of your first purchase, that house may be completely paid off. You may be able to sell that house on a seller finance note and really get mailbox money. That's a great strategy. It's not for everybody, but really getting clear on what you're trying to accomplish is really, really important.
100%, man, 100%. You said so many good things there. I mean, syndication, so I love them. I make a living off of syndications. I'm a securities attorney.
Yeah.
I work at TriVest. It's a great vehicle, but I do think that kind of the traditional sense of it where people are like, all right, let's syndicate this deal. Let's flip it basically as quick as possible.
Yes.
Like if we can unload it in 2 years, let's unload it in 2 years. It's like they just turn into house flipping, but with apartment flipping.
Glorified,
right?
yes.
Yeah. And it's just like, that's not why we got into it, or most of us, I shouldn't say everyone, but most of us got into this thing for long-term, for cash flow, for freedom, flexibility. And that's not, because that's just like, okay, well, I got to live for my upfront fee. I've got to live for the exit fee. I'm not making any money in between. I know a lot of capital raisers and syndicators got washed out in this last market because there's no cash flow, right? Mm-hmm. Like they made a little bit of money when they started. They're going to make maybe not now, but they were planning on making some money on the back end, on the sale, possibly on the refi, which has gotten washed out too at this point. And it's like there's no cash flow for these people, right? So they've had to go back and get a W-2. They went back to work. They haven't been able to sustain. So you're seeing a lot of people get washed out with that model. But you can still use that model, just your investors have to know that you want to stay in it for the long term.
Yes.
Right? You have to set those expectations first. It's like, we're not trying to sell this thing in 2 or 3 years. We're gonna keep this as long as we can. We're just gonna keep refinancing it. We're gonna keep improving it. We're gonna keep doing these things, and you're gonna get your capital back, and you're gonna get great returns, or you might get great returns. But we're not trying to get out of this as soon as possible. So plan on staying with us for the long term.
You said a couple of really important things there that I don't want to gloss over. The first one is know who your investor is. If you're going to create that model, and I love that part of the syndication model, it's tell your investor, this is not a 2-year fix and flip and we're going to sell it. We're buying this thing for tax benefits. So the longer we hold it, the better it is. We want to give you some kind of IRR number, but we're really focusing on holding this asset. Why would I kill the golden goose if my goal is to really reposition this asset, really get it up to snuff, and maybe refinance some of the capital out, distribute it back to you, and continue to hold this, operate this like a business. That's what my model is. See, the syndication model, sometimes it doesn't lend itself to really running real estate as a business. The managed right portion is so important, and operators out there, they know that, hey, asset management is important, but you need to couple it with property management. Those two components are so important for the business. And there's another thing you said in there that really caught my mind. The fixing and flipping is so important. It's understanding what your role is and what you're trying to do. And I think as a syndicator, it could work if you put your money on the LP side as well. If you're just going in there with no money down, I think you need to start investing in your own deals. And I've seen syndicators not invest in their deals, and there's less of an alignment, in my opinion at least, with the general partnership and the limited partners. I want, as our general partnership team, to put that money into the deal, to show that there's confidence in the deal. But I love your model of going in there, looking at this asset, not saying a 3-year exit. Now, if the market lends itself for you to make a ton of money after 3 years, and you'd be foolish not to get it, and you understand market cycles, and you're like, hey, I got to hold this thing for the next 15 years to get my cash flow back if I sell this thing today, then maybe it behooves you, because you have to do you're a fiduciary for your investors. You got to do what's best for them, not what's best for you. So that may preclude itself, but understanding that if you can tell them, hey, this is a business, I really want to run this thing as a business, and I really want to cash flow this thing and control it. I think that is a good way in setting the expectations with your investors. If you do that, I like that model with syndication personally.
Yeah, I think people are a lot more open to it now too
Yeah.
than
Yes.
they were, let's say, 5 years ago, when that was just kind of what everybody was doing, right? There's no alternative to that. It's like, oh, great, like rents are going up so fast, the market is so good, like we're basically just going to sit on this and for 2 years, and then we're going to just sell it for,
Yes.
and we're going to 2x our money in 2 years, and that's great. I mean, for investors, they're like, yeah, sure, we're going to do that. But now that it's a little bit harder to pull that off, I think people are going to be a lot more open to that. Well, they are more open to that long-term kind of, I call it traditional kind of way, right? Like that's why I get into real estate for those reasons. So I think investors are more open to that. And you're actually seeing that with like other asset types too, because they want cash flow. You're just seeing people get away from multifamily a little bit, get into oil and gas for the tax benefits, for the immediate cash flow if it's the right one, and like the debt fund, things like that, because people want the cash flow. They want to stay in it for 10 years. They don't want to figure out what they got to do with their money here in 2 years again.
It's interesting. Have you ever heard of a gentleman named Sam Freshman? I don't know if you've ever read his book. He's got that really thick book on syndications. I mean, it'll put you to sleep. But I mean, it's great content, and he's written a couple of books for younger people. Honestly, I would be lying if I knew if he was still alive. When I had him on the podcast, he was in his late 80s and massive syndicator. 2 mistakes he said he made. I mean, he'd been syndicating deals and owning deals in California, and his model is very similar to what we're talking about. But his 2 biggest mistakes was not buying enough real estate and selling too soon. And if you think about that, it's incredible. And I can give you an illustration exactly what he's talking about. Jake and I, when bought our first deal, it was called the Shamrock Motel in 2013. It was a 25-unit little crappy property.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Sounds classy.
Dude, I'm telling you, Shamrock was 6-unit, a little efficiency. It had cottages. It still has them. It had a couple duplexes on the property, 25 units. We paid $675,000 for the property. What did it come out to? About $25 a door. Rents were week. It was weekly renters. Over the years, we were able to fix it up. We were able to refi out. We put down $87,000. We were able to refi $160,000, back in 2015. We currently still own this asset. It's 2025. The asset is probably worth $125 a door right now. We paid $25 a door. That asset would have traded hands 3 or 4 times. Now, my point is, we bought it at that price point. It's still producing between $8,000 and $10,000 a month in cash flow on a crappy little 25-unit asset. Now, when you talk about like wealth, that is printing money. Now, that asset's probably, like I said, is it worth $2.5 million at $100 a door? So you can see there's a ton of equity. We can go back in the next 2 years, refi some of that equity out. And that's the thing with real estate. Real estate, it's different than businesses. You can exit an asset in real estate without selling it. The refi is so powerful because it's basically a loan to yourself, so you're not paying taxes on that loan unless you end up selling it. So for us, we did the Sam Freshman model. And the reason why we kept it's because it was pretty easy to fix. The basis was low. We love the area and the market that it's in. Rents are going to continue to rise in that market. It's an easy asset to manage because it's an affordable kind of asset where people want to be into it. These 1-bedroom cottages, they feel like homes. They feel like apartment homes. So there's very little turnover in these things. So understanding you need to buy the right asset to be able to hold long term. But I'm telling you, just from that 25-unit little property, it's incredible if you have that mindset of buying the right deals and giving yourself a little bit of time to be able to create wealth. It's incredible what can happen.
Yeah, for sure. And how do you present kind of like all these different pathways that you can take to your coaching clients? I know that, a lot of people a lot of folks out there that are teaching stuff, like they just kind of zoom in on, okay, look, multifamily syndication, for instance, right? Like that's the only way. There's no other way to do it. Or, I'm just RV parks. Like you have to do RV parks because you got to ride this wave. Or, they're always focusing on like one very specific thing. Now I know you love multifamily, but it sounds like you kind of look at the general picture for each person, investor, student, whoever it might be, and they kind of have their own, they need to figure out their own pathway. How are you able to kind of coach that out of them?
And that's a great question. That's why I've transitioned into money coaching, because I always see the problem. And I'll give you a perfect example. Student named Ethan, 17 years old. He bought his first deal. He couldn't even sign on the docs because he wasn't an adult yet. You need to be 18 to sign on an LLC and close a contract. His dad had to buy the deal for him. Fast forward, he's 23 years old, probably owns 300 units, syndicated deals. How does that kid do it? He never went to high school, for God's sake. How can somebody at that age with no experience, no capital, be able to do that? Then you take a gentleman who's in their 40s or a woman in their 40s. They've got a nice balance sheet. They've got 7 figures net worth, and they can't close a deal. And I'm like, holy crap, how is that? It didn't make sense to me. I'm out here teaching the framework. And the first part of the answer to your question is, I'm not going to tell you what vehicle anymore because I don't specifically train just on real estate. But I would say is you need to learn the framework of the buy right, the manage right, and the finance right. There's little tweaks, right? Buying a multifamily, there's different buy right criterias as opposed to buying a self-storage. Buying a multifamily, the management, the expense ratios and all that, it's a little different than it is in self-storage. But the basic foundational principles are all the same. You need to buy it properly. You need to finance it, whether that's community, using seller finance notes, Fannie and Freddie, whatever that looks like, and then the managed portion. So I would say those 3 pillars, you can buy a business, you can invest in any asset using that. But then let's peel that onion again. Once again, what happened with Ethan as opposed to this person in their 40s? Well, Ethan had a much better relationship with money because he had a father who was a doctor, who was entrepreneurial. All these messages that he heard from his dad growing up, the positivity of making money, going out there, and you know what, son, I want you to go to college because I'm a doctor, but if you want to do this real estate thing, I am going to be there for you. And what does that do? All of a sudden, the patterns and the behaviors and your beliefs around money are completely different. And I'm a product of that. It took me forever. I was 43 years old before I bought a deal with Jake. I mean, I was there. I don't want to say terrible, but I had a challenging relationship with money. I had a lot of limiting beliefs. It takes money to make money. Money doesn't grow on trees. We've got to save for a rainy day. Be afraid. Scarcity. Yeah. And if you don't explore that, it's going to hold you back because at some point, there's going to come a deal and you're going to be like, wow, I finally got a deal. But where am I going to find the money? And how am I going to do it? And all these beliefs pop into your head, and then you don't put the LOI in. You wait a week, and then that deal goes off market, and someone else bought it. That's really important, understanding that relationship that you have with money and fleshing out what are you doing wrong as well as what you're doing right. What patterns do you have that are really empowering and which patterns are disempowering? Which patterns do you want to start adopting? And that is a longer conversation than just saying pick this strategy or that strategy. But that's really where we should start, Seth, if you're asking me what investment vehicle. Before the investment vehicle, let's figure out what's going on underneath the hood before you actually start putting the key in the ignition and driving that car away.
Yeah, I love that, man. I grew up in a blue-collar family as well. I wasn't around entrepreneurship or buying real estate or any of those sorts of things. My dad's a retired coal miner. My mom's a retired school teacher. So I didn't come from that. So it was like, for me, it was like get the best job you can get. Like trade your time for money, and that's just how it works. But at least try to get the best one you can. That's why I went to med school for a little bit, because that in my mind was like, okay, what can I do? What's the best job I can get? It's going to be a doctor. And then I hated that, got out of that, and I was like, all right, I'm still in that mindset. I was like, well, what's the next best job I can get? I was like, all right, I guess I'll be a lawyer. So then I went to law school. Turns out that worked out pretty well because I could leverage that skill set into a lot of entrepreneurial things. But I was still stuck in that mindset forever. I mean, forever.
And what changed? What made you change that mindset? Was there any person, any group, any mentor, any event in your life?
Yeah, I mean, it was pretty typical, man. I read the Purple Bible, Rich Dad, Poor Dad, and that just kind of, just changes. It's a simple book, but it just changes your mindset a little bit. At the time, BiggerPockets is still big, but it was like really big, around 2013. Like that was like the real estate thing and into the chat forums and all those things on BiggerPockets, and that got my mind going. That's when I house hacked into a duplex with my wife.
What was the anger?
To do it.
What was the anger when you read that book? Well, I'm sorry, I gave it away. What was the emotion? What was the emotion when you read that book? What was when you read that book?
It was like a thirst for freedom. I don't know. I think I'm like entrepreneurial to my core, but I don't think I knew it until that time. Like I don't think that I knew it because I didn't know it exists. Like I didn't know it was possible for me. And then as an attorney, I got around entrepreneurs as clients. So I got around syndicators. I got around people that were buying big pieces of real estate. And I was like, man, how in the world do they do that? And even then it was still a mystery. It was like, even though I'm helping them close a deal, but I was like, well, that can never be me, right? Like how can I they probably had a trust fund or something, or, Donald Trump's their dad. I don't know, something crazy, right?
Yes.
But then I realized, it's not, right? It's not that hard. You just have to take a little bit of risk. You got to change your mindset a little bit, and we can all get into those sorts of things. But, growing up the way that I did, it was a big mindset shift to get there.
I'm going to ask you another question, but my story is very similar to yours, where I read The Secrets of the Millionaire Mind, and the emotion that I had was anger. I was just pissed. And anger is actually really good unless it turns into resentment, right? Sure. Anger is a really good emotion if you can channel it. And I channeled it into listening to Jim Rohn, Zig Ziglar, and I channeled it into something positive, into saying, I'm going to take responsibility. I'm going to take some massive action. So if you could do that, that's great. But then what happens is if people get that anger and they get that resentment and they that's not a good way to lead the anger. Anger can be really good. If you're moving away from pain, that's really good. Then you ultimately want to move towards pleasure. But when you say you're entrepreneurial to your core, what happens is, as we're younger, we either adopt our parents' identities, beliefs, patterns, or sometimes we move away from them. We do the exact opposite of what they did. And I'm wondering did you see your dad's job as like, I don't want to be stuck in a coal mine. I want to have opportunity. I want to make money. And you saw med school, a lot of money, and that's where you jumped. Do you think that affected your thought
100%,
process?
100%. And he even told me, he's like, you don't want to do this. Like you do not want to be doing this. So you've got to do better for yourself than this. But that pathway was still kind of the W-2 mindset, trading time for money, not necessarily entrepreneurship, because my parents didn't know that. Like they weren't entrepreneurs, so they weren't able to give me those ideas at a young age because they didn't have them. So they're not able to pass those on.
And that's why it's important, because if you're listening to this right now, you may be making those decisions based upon unconscious behaviors or beliefs or things that your parents were telling you. Like my mom would tell me, Gino, don't take risk. Stay small. We're immigrants. We're little fish. That's why I had one restaurant for 20 years. How do you explain having 500 apartment units in less than 5 years with Jake? It really comes down to, I shattered those beliefs and those patterns that were, I don't want to say pushed on me by my mom, but when you hear these things for years and years and years, that's what you adopt. And I finally got sick and tired of it, and I did the opposite. And then from having all these mentors and having these different things that you're listening to, it's all of a sudden you're creating your own patterns and your own beliefs. But if you don't at least take that step or become conscious of it, I was just fortunate. I became a life coach. I started noticing these things. But that's a difference, I think, somebody when they're doing really well with money, understanding what it is and understanding how the past can help you, but it can also hinder you. And you went right into med school. So anybody listening to this, just question yourself, why are you getting into the ventures you're getting? Why do you need $1 billion in real estate? Why are you even getting into real estate? Are you getting into it because your parents did it? Or are you getting into it because you hate your job and you just want to do this to make more money? That usually isn't the good result of why you're doing it. Just start questioning the things that you're doing, especially around making decisions with money.
Yeah, I mean, we've gone full circle, man. You got to pause and you got to think. Mm-hmm. Have some deep thoughts and say, like, what are your goals and why? Like, why are those your goals? Yes. You're not just making up a number. Are you saying I want to own $1 billion in real estate because you actually do, or is it just kind of like a number? You're just like, yeah, $1 billion real estate, cool, I'm going to own that. I want to own that, great. But why? Like, are you going to be able to sacrifice what you need to sacrifice to get there? Are you going to be happy at the end of your lifetime and say, I enjoyed that and that was worthwhile? I don't know. Maybe. It depends on what you had to do to get there. So you got to stop, and before you kind of go down a lot of these ventures, think about what it is that you want, the type of life that you want to live, the time you want to spend with your family. Like you've got to have some introspection into that sort of thing.
Let's give them a little framework on how they can do that, because that's important, what you said. My mentor taught me a word or a phrase called values-based decision making. Every decision that you make is based on your values, not Gino's values, not Seth's values. And you have to understand that values are created early on in life, and they're just carried through. I was 8 years old, going to the restaurant, working with my dad. Values of hard work, I would say entrepreneurship a little bit, but really being loyal, showing up, being a good provider, loving my family, growing. These are all things that I learned early on, and they've come into my adulthood. So now when you're making a decision, whether it's taking a job, whether it's living in a different area, whether it's investing in an asset, does that align with what you're doing? I had the opportunity for a company to invest, to partner up with us and market on our website, on our podcast. It's a cannabis company. Money's great, just doesn't align with my values. I cannot align with something like that. I've got 6 kids. I want to practice my faith. I'm not saying it's good or bad for anybody else. It just doesn't fit with me. So that's how you make those decisions. And once you're clear about that, you can make decisions so easy. Just like when you have a buy box. I'm buying a multifamily, 20 to 200 units, $50,000 median income, 2-bedroom, 1.5 bath townhomes. I like garages. If you've got washer and dryers, great. Brick exterior, anything after the 1980s. Really clear. That's my buy right. That would be my values that I'm looking for in a multifamily asset. Translate that into anything. And I'll give you one last example. When I was here back in 2017, I had just moved to Florida, and I was doing really well with multifamily, but I got the itch. I'm like, I'm in Florida. This vacation rental thing's going great. I met a guy down here that I really liked. He introduced me to these 2 other, I would call them jabronis, for lack of a better word. I just didn't have the right feel, Seth, but the model was good. We're buying these vacation homes. This guy was a builder, and he was a property manager, and we were getting them at good bases, but it didn't feel right. Now looking back at it, it didn't align with my values. My values and their values did not align, and that's why ultimately, fortunately, I only lost $30,000 on this venture. It could have lost more, but to me, it didn't align with the values, the long-termism, the way the partnership, the integrity, the openness, the commitment, the expectation of outcomes, all of that didn't align, and I didn't know. And I could have blamed the partners, but ultimately I need to blame myself and take responsibility because it wasn't aligned with my values. So just have an open mind. If you want to set goals with your values in mind, that in case you value having time with the family, being able to jump on podcasts, being able to take 2 weeks off a year, are you going to be able to do that if you want to hit $1 billion in real estate? Now, I'm not saying that you can't, but they may not be congruent, because if you ultimately do hit $1 billion in real estate, you may be miserable as hell because all that stuff that's really important to you, singing opera, going to shoot guns, going to fish, going to hang out with the kids on the weekends, that may go by the wayside. So I'm not saying the goal is good or not. Just make sure that it aligns with your values.
100%, man. I love that. What are a couple of your core values? What are your, what is the primary couple of core values that you just live by?
Well, for Jake and Gino and our property management company, it's people first, unwavering ethics, extreme ownership, make it happen, and growth mindset. That's why when I'm not growing, I'm annoyed. When I'm not learning something or I'm not part of something, it's bothering me because I'm in transition right now, right? I'm sitting here, Jake's doing the property management, I'm still doing a little bit of the education, but I need to be part of something, and I understand that. So if there's an opportunity for me to learn and to enjoy and have fun, that's what I love. And I think to me, people first is important. I always thought with those small businesses that I was always a part of, I wanted to have really great people. I didn't like the job at the restaurant. So ultimately, I'm saying to myself, I want employees to come into work or be on a podcast with me or have a conversation or be part of the company where they're empowered, they're enjoying to be there. That's what I wanted. That's why for me, people first is such an important core values. And I mean, obviously make it happen. I mean, sounds like a little marketing thing, but man, I want to live by that because I've got a bunch of kids. I've got an amazing wife. She seems like she's always trying to make it happen, and she does. I want to make sure that I end up to my end of the bargain and do it well. And when you have a business partner like Jake, who's just incredible, he's an incredible dude. The guy never complains. He goes on vacation. He takes care of business. There's never any excuse. So for him to be able to do that, I don't want to be the slacker or anything. I like, once again, it's the responsibility. It's the control. It's part of my values. I want to be part of that team.
Yeah, those are some really good ones, man. Really good. We kind of touched on this a little bit, but I'd love to hear this because there could have been a lot of different ways you could have gone. But in a parallel universe, tell me about a different version of you. For example, for myself, told you I went to medical school. I could have easily finished that, went down that pathway, and that would have looked a lot different than where I'm sitting today. What was there a time in your life where there was that kind of one turning point and you could have went down a different pathway? Not a bad way, but just different. What's a different version?
When I was younger and I graduated college in '92, there were no jobs. Job market sucked. I went to work for AIG, and I think if the job market had been better and I had found the job that I liked, I actually wanted to work for a company called Value Line, which did stocks. They're probably still in business, but they're a shell of what they were. You look at these reports, they're 6 months old, but I love the stock market. I loved analyzing. If I had not had a tough time finding a job that I liked, I probably would not have bought the restaurant. I would have stayed down on Wall Street, would have made a ton of money, probably wouldn't have been happy, and then I never would have met my wife, and then everything would have completely changed from there. So I think God closed that door of working down in Manhattan and said, you know what? You've got to struggle for a few years. You've got to buy a restaurant. You're going to like it. It's going to be difficult, but that's the door. And I would have been a completely different person in a completely different venture, living a completely different life.
Yeah, it's crazy. Sometimes you can look back and there's a few things that easily could have gone the other way, and you probably would have preferred it at the time to go that way. And you're like, man, where would I have been? Where would I have been? Crazy how life works.
Great question.
Yeah.
Thanks for that.
Yeah. All right, brother. I don't ask everybody this, but I think you'll enjoy this one. But when you're gone, what's one thing that you want people to remember you by?
Well, I mean, it's interesting. You obviously saw what happened last week with Charlie Kirk. Don't know if you're a friend or not, or if you know him or not. I'm not going to say I was a rabid fan. I really enjoyed him. But what I like most about him is the way that people are really talking about him. Like his wife said that, he never raised his voice. And I have to say that, when I'm not here, I want my wife to be able to say that about me. I want my kids to say, Dad would take a bullet for me. I want the people that I worked with, I want my investors, I want my friends and my family to say, that dude was really cool. He lived by his values. He helped a lot of people out, and he left the world a better place. Now, you may agree or disagree with his policies, what he talked about, but you saw what he did with a lot of young people. He helped a lot of people out that were struggling. Forget about his politics. I'm just saying there's a lot of people out there that he empowered, that he made actually become thinkers. And I think I'd like to leave that kind of legacy myself, where I can help, me and my wife are talking about this, change the world one family at a time. Because I think the family is just the core of what this country should be all about. Because if you have a healthy family unit, then that family unit can grow, and that family unit can help other family units. Then all of a sudden, we don't really need to rely on other people as much. We can rely on our families.
Yeah. Well, you're doing it, man. You're doing it, brother. Appreciate you. Where can our listeners find out more about you?
Just go to jakeandgino.com, and if you want to learn about the family company, it's Barbaro, Barbaro 360.com.
All right, brother. Thanks again. I really appreciate you coming on the show, man. Always a pleasure talking to you.
Thanks, Seth.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.